What are your thoughts on the effectiveness of the current UK tax system?
Quite a lot of our tax system, when you actually say, why do we have this particular rule? The answer when you get into it is often, well, we've had it like that for a long time and it's difficult to change. But there's a lot of parts of the tax system that don't have a good economic rationale. The way it's designed, you can actually, at the moment, effectively game the system. Even amongst people who have the same amount of total income, they can end up paying really different tax rates.
So, in your opinion, what groups benefits the most and least from the UK tax system?
Basically, employees get the worst deal. They pay the highest effective tax rates, and that's obviously most of the population. We don't want the tax system to distort people's decisions about how they work.
Many believe wealth inequality is going to continue to grow. Do you think a wealth tax, the introduction of a wealth tax, could help narrow that?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people. Like
you have to be able to be uncomfortable.
Yeah.
Like, be comfortable with being uncomfortable.
When you grow up in ends, you don't realise it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Dr. Andy, who is an Associate Professor of Law at the London School of Economics, where he teaches a master level courses on taxation, including taxation of wealth and tax policy and design. He also teaches an undergraduate module on tax and tax avoidance on tax avoidance, as well as an executive master's course on the taxation of wealth. His research focuses on the evaluation design of tax policies, particularly those affecting top earners and high net worth individuals. He's the director of the Centre for Analysis of Taxation, a research centre dedicated to improving public understanding of tax and contributing to the design of a more effective tax system. Dr. Andy, how are you doing today?
Great, thanks. Thanks a lot for having me.
You're welcome. I think this is going to be a very interesting conversation. I've had a few conversations about tax. Even currently right now, there's a lot of conversation about taxing the wealthy, the tax system. So I thought it would be, a very valuable conversation to have a conversation with somebody who actually deep dives in this, does a lot of research around this and actually, try and understand it a bit better. Right. So, I described a little bit about you. Right. So I guess, could you briefly share your background and what inspired you to become a law professor specializing in tax policy and design?
Yeah, sure. So I'm a lawyer by training, but I didn't actually start out either necessarily wanting to be an academic or wanting to work in tax. I kind of have ended up doing that. Actually, quite a lot of the development of my interest in tax has been since I started working about 10 years or so ago now at the London School of Economics. So obviously, as the name suggests, there's an economics department there. It's a social science kind of university, and there's quite a lot of working of people across disciplines. So it's an area where if you're a lawyer, you can actually work with economists, people from other subjects, and I think that's a really important way of getting to the key issues in tax policy, that you really do need people with different expertise working together. So I've sort of found my niche, hopefully, in this area where I can contribute my legal expertise, working with economists and other people to study the tax system. And I think it's an area which, I always say this when I'm sort of teaching my courses, tax is a funny area where on the one hand, if you say I work in tax, it can be a bit of a conversation killer, right? People have this idea of tax as kind of dry, technical subject. And then you get talking to them a bit more, and it turns out everybody has really strong views about the tax system. You can talk to anybody and they'll have a view on, should we abolish inheritance tax? Should the rich be paying a higher rate of income tax, and so on? And so I think it's really important that we're able to connect that kind of everyday views about the tax system with the sort of underlying rigorous research, or that's what we're trying to do.
Yeah. And this is why I think this will be a perfect conversation for that, because it's like you say, right? Tax and even just personal finance in general can be like this kind of, like you say, sometimes people can think it's dry, people think it's technical. We try our best on the podcast to not make it like that, maybe more applicable to everybody's daily lives, because at the end of the day, it affects all of us. So I think it's it's important for us to understand. So really appreciate that. So so let's delve into like the current tax system, right? And like that kind of understanding of it, right? So how does the UK currently tax wealth, should we say?
Okay, so I guess the first thing to point out is maybe obvious, but the UK doesn't currently have a wealth tax as such. We don't have a tax that is based on the total amount of wealth that somebody has. Some countries do have a wealth tax like that. Quite a few countries have had it historically, and actually, they've got rid of it. The UK doesn't have one and has never had one. It got quite close to implementing one in the 1970s. It got actually as far as the government putting in draft legislation, and then they sort of backed off it. But the UK has never had an actual wealth tax. But we do have lots of taxes that affect wealthy individuals. So, for example, we have taxes on the returns that you get from wealth. So if you own an asset and you receive income from it, like if you have savings and you're getting interest on that, or if you own some property and you're renting it out, or if you own shares in a company and you get paid dividends, all of those returns on wealth, the income is subject to income tax. Then if you sell assets at a profit, then you might also have to pay capital gains tax. So that's another tax on the returns on wealth. And then if you want to pass on wealth after you die, then there might be inheritance tax on that. And we do have other taxes that are sort of like taxes on specific assets. So even you could think of council tax as a tax on property wealth, although it's a bit of an odd one because it's the tax is formally levied on the occupier, so the person who's living there, not the owner. But so there's quite a few taxes that we have at the moment that you could say particularly affect people with wealth, even though we don't have currently an actual wealth tax.
And even just the number of taxes that you mentioned,
it's quite
that's
a few
four
already.
out of numerous taxes.
I'm just scratching the surface,
right?
of it,
like, and this is why I think a lot of people kind of get confused with it. It's like every aspect of your life is taxed, like you say, like where you're living, right? There's a form of tax that's in the form of council tax. When you get income, there's a form of tax there. When you're selling your assets, there's a form of tax there. When and I
find that really interesting because one of the things a lot of people object to about inheritance tax is they say, oh, well, it's double taxation because the person has paid income tax through their life, they've saved up all this money, and then when they die, the government taxes it again. I mean, there's quite a few things you could say about that double tax argument, but one is just, well, actually, that happens with a lot of other taxes as well. So if I buy something in the shops, I'm paying VAT on that purchase, even though I've already paid income tax on the income that I've used to fund that purchase. So sort of, there's all these different layers of taxation. And what we kind of want to do ideally is think about the sort of overall effect of all of those taxes on individuals, rather than necessarily thinking about the impact of each of those taxes on their own.
So what are your thoughts on the effectiveness of the current UK tax system?
So I would say there is a lot of room for improvement.
Okay.
We have quite a lot of our tax system. When you actually say, why do we have this particular rule? The answer when you get into it is often, well, we've had it like that for a long time and it's difficult to change. But there's a lot of parts of the tax system that don't have a good either economic rationale or whichever way you look at it, the position is hard to defend. Like, let me give you one example a lot of people will recognise because it's council tax. The amount of council tax that you pay depends on the value of your property in 1991.
That's true.
And people often ask me, okay, how does that work for properties that have been built since 1991, because there's a lot of new builds and so on. And the crazy answer is, what you technically have to do is figure out how much that property would have been worth in 1991, even though it was built 5 years ago. So nobody thinks that, nobody thinks, oh yeah, what you would ideally do is design a system where the valuations are now, 35 years out of date. But we have these things. It's a product of a lot of sort of incremental changes, and then politicians, sometimes for good reasons, sometimes for bad, sort of think these things are very difficult to change, and we gradually end up with a system that doesn't make a lot of sense, except that things can be difficult to change.
Yeah, it's so interesting. There's like two things I want to kind of discuss on that, right? The council tax one's so interesting because, like you say, it's based on this what your home would have been on 1991, yet they increase it every year. So it's like, okay, if you're saying it's based on that, why is it then increasing? So right? What the 1991 value determines what band you're in. Okay, cool.
Yeah. So the way council tax works is there are these different bands, like they've got different letters, and then each individual council can, to some extent, they don't have total freedom, but they can choose to some extent what the overall level is for each of those bands. But which band you're in is determined by that 1991 property value.
Gosh, yeah, it's still, honestly, I think you're right though that it still doesn't really make much sense, and it's probably up for debate. I think a lot, and it's a source of pain for many people because of how big the increases are. They're not small increases, not like a 0.1% or even a 1%. It's like a little bit higher as well. So, and also the fact that there's not a good reason for some of them, right? I guess if they say it's difficult to change, does that mean it's impossible, or is it just like, no, we just don't want to move?
I think it's a political question. I mean, on this issue of valuation, I should be careful because we're here in London, and London is probably the biggest beneficiary of having used those 1991 valuations, because London house prices have gone up a lot more in London since then than they have in other parts of the country. So relatively, London is kind of benefiting from that, but it's not obviously fair in some sense that we have these outdated valuations, and because some councils within London have charged relatively low rates, you can get into these quite crazy situations where a sort of penthouse overlooking Hyde Park in London is paying the same amount of council tax as a pretty standard terraced house in Burnley or something in the north of England. And that is, again, when you stand back from that, you think we wouldn't have designed a system that way, but anytime you want to make a change, you're going to get sort of losers from that change. Actually, in the case of council tax, some of those losers would be heavily concentrated in London. And I suppose politicians think, is that worth the aggravation from the losers to sort of benefit the winners?
Okay, that's interesting, because I live on the outskirts of London, and that's interesting. So
maybe it doesn't feel like you're a beneficiary.
Yeah, I mean, it's expensive enough, right? So it's like, okay, that probably would not be an argument that they would win, to say that council tax could potentially go up even more. If you,
I think, I mean, the other part of this is that those bans for council tax, they're regressive in the sense that there's a top band which is in current value terms, so not 1991, is about £2 million. Anything above that still pays the same council tax. So even if you have a £10 million property, you're paying the same as a £2 million property. It doesn't get more as it goes higher up. So one thing the government, I think, could do would be to add some extra bands on top of that. They'd raise more revenue from those very expensive properties, and potentially could use that to cut council tax for those lower value properties. So
that's a good proposition.
It's my first proposal of the night.
And we've got more proposals to definitely talk about. Okay, so I'll move us on, because there's a lot of interesting questions I have for you. So to what extent do you believe the current UK tax system is fair for individuals across the different income levels?
So I think, questions about fairness are quite tricky because in some sense, everyone would say, yeah, we should have a fair tax system. And then you sort of scratch below that a little bit and people have different views about what is fair. I think one thing that really stands out from the UK tax system is not even so much how the amount of tax you pay changes as your income changes, but that even amongst people who have the same amount of total income, they can end up paying really different tax rates.
Yeah.
And that's quite surprising to people if you're sort of, most people think in terms of what are the tax rates on employment income, because that's where most people get most of their income from. And the tax rate for employment income goes up, as you probably know. The income tax rate goes up from, well, there's this personal allowance where there's effectively no tax. Then there's a 20% rate, a 40% rate, and at the top, a 45% rate. If you earn employment income, you'd also have to pay employee national insurance contributions. So that's going to add another, at the top, another 2%. Lower down, it's actually more than that. So people kind of familiar with those tax rates. But if you get your money from, for example, capital gains, so from selling assets at a profit, and so you get this, what we've shown in our research is you've got changes in tax rates as you go up the income distribution as people get richer in some sense. But you've also got cases where people at the same level of total income some of them are paying sort of over 50%, or at least over, depending exactly how you measure it, over 45% in tax. And so I think that is an area where, on fairness grounds at least, it becomes quite hard to justify.
Yeah, that's true. And it just shows that, like, in terms of fairness, like you say, it could definitely, I could see the arguments why people may think that, somebody, like you said, getting similar incomes, one can have a lower tax rate because of, let me not say privileges, is because they took a different route, whereas somebody who's maybe working for somebody else is getting taxed more, which is always very quite interesting as well. We've all experienced buyer's remorse, spending money on something and instantly wishing you could take it back. Leaving your business funds in a regular current account is just like that regretful purchase. It's a missed opportunity. The money's sitting there doing nothing when it could be earning interest and working for you. There's so many ways to grow a business, and using a high interest savings account is one of the lowest effort wins you can get. With rising business expenses like staff costs, travel, marketing, and software subscriptions, why not let your business savings do some of the heavy lifting? So I made the switch to Tide's instant savings account, which earns me up to 4.48% AR variable on my business savings automatically, no extra admin required. The more you save, the higher the rate. So my money's always working at its best. I can access my business funds instantly with no withdrawal fees, and you don't even have to bank with Tide to use it. You can open an account with just £1 and it's FSCS protected up to £85,000. And because I know how valuable this could be for my community, I've partnered with Tide to bring you an exclusive offer. Get a £100 bonus when you open and fund a Tide's instant savings account with £5,000 within the first 30 days, and use my code SavvyWallet. Plus, for the first 6 months, new members can earn up to 4.48% AR variable on their business savings. Setting up your Tide instant savings account takes just 3 simple steps. Tap the link in the episode description, enter the code SavvyWallet, and start putting your money to work. New Tide members receive up to 4.48% AR variable on balances over £1 million, free for 6 months. Then your Tide's planned savings rate and thresholds apply. For the full offer, T's and C's, visit tide.co/savings. Rate correct as of the 15th of April 2025. I guess with that, why do you think that's designed that way though?
Yeah.
In a way where it's like similar, let's say, money, but different taxes?
Yeah. So I think with capital gains, and that's the biggest extreme, is if you're getting capital gains, you're paying a lot lower rate than if you're getting employment income. The thought is the government always feels a bit torn between, it kind of has often realised that it seems a bit unfair to be giving lower tax rates for some types of income than others. But on the other hand, you want to encourage investment in businesses. And so the idea is, keep the tax rate low in order to incentivize people to invest in businesses and so on. I think the problem with that is that the way it's designed, you can actually, at the moment, effectively game the system by turning what most people would think of as earning money from work into a capital gain by, instead of working for another company and being an employee and paying tax on employment income, if you set up a business that provides your services through a company and then you build up profits in that company and sell it, then that turns it into a capital gain, even though originally the profits were generated from you doing work, just in the kind of the same way as somebody who's working for an employer. So what we've said from our research that we've done into this is and we're not the first people to say this, so the Institute for Fiscal Studies, which is a big kind of research organisation on tax, have been saying this for a long time. What you should do is give an allowance to people who are making genuine investments, but increase the tax rate so that it's actually the same rate as income. And what that means is people who are genuinely investing, actually in some cases they would be better off under that regime, but people who are just converting their work income into capital gains, they would pay a higher tax rate, which would be the same sort of tax rate as if they were just employees. And I think that potentially makes a lot of sense.
Interesting. I'm sure the business owners listening would be like, we would not be happy doing that. No way, Andy. That would not be okay. You know, we like gaming the system.
Yeah, I do. I wonder how many people sort of knew, because you said capital gains is complicated.
It is, yeah.
I wonder how many people, when they have a great business idea and they're setting up a business, actually are thinking about, you know, if I make all my millions, am I okay with paying this higher tax rate? I suspect, and there is some actual research into this, that most people, if they're aware of the capital gains tax treatment at all, it's not what's constraining them originally when they want to set up a business. So there are all sorts of difficulties of being a business owner, like can you get the finance you need to get this idea off the ground, and those sorts of things will definitely stop, you know, startups from progressing. But whether it's really the case that lots of people would say, oh, I can't be bothered because if I make £10 million I'll have to pay 40% tax. I mean, most people would say if I make £10 million I'll be quite happy.
Yeah, true.
So it's a tricky one, because there are trade-offs, but we would say that it's a better way to support early stage businesses would be to help them with those other things, rather than just giving a very large tax break to the businesses that turn out in the end to be successful.
Yeah, so it's more about supporting those businesses to actually grow into thriving businesses, maybe providing capital, you know, and a loan on good terms, things like that, the infrastructure to actually grow the business rather than like a tax break.
Yeah.
Because actually that's not, although yes, they are paying less tax, is that actually going to help like startups actually thrive?
That's right. Yeah. I mean, I think people say kind of, we want to support risk taking. The thing about risk taking is if it's really a risk, it could go well or it could go badly. And at the outset, you don't know whether it's going to go well or badly. And so a system which only supports the people who turn out to be winners isn't necessarily the best system for supporting risk taking.
Yeah, that's interesting. Okay, so what do you think is the best, you know? I might be asking you earlier. I like that because I want to stand on that point.
So we think you should get what we call an investment allowance based on the amount of actual capital that you put into your business, equal to, essentially, it's kind of at the same rate as if you had just put this money into a bank account. We don't want to charge you tax on that return. We only want to charge tax if you're getting a higher return than that. And that actually means at the moment people are paying these low rates of capital gains tax, but they're paying it on the what's called the nominal gain, just how much in pounds terms the asset has gone up in value if it's shares that you've sold for more. Whereas if you've actually put investment into the business, the combined effect of an investment allowance and increasing the tax rate, in some cases makes you better off. I won't pretend that for startup business owners, a lot of them would pay more tax under that kind of regime. But the government then obviously has a choice about how it uses that extra revenue. It could use it to support startup businesses in some other way.
Yeah. Okay. Cool. I like the proposals. That's the second proposal, so we got a few more to definitely go through. So, in your opinion, what groups benefits the most, and least, from the UK tax system? I think you might have kind of alluded to it, but just wanted to ask you that again.
Yeah, I think if you're able to sort of diversify your sources of income, basically employees get the worst deal, or they pay the highest effective tax rates, and that's obviously most of the population. If you're able to receive income from rent or from dividends and from owning shares in a company, or for example, if you receive gifts or inheritances from a relative or something, then those are all. I mean, it's difficult to say, are they taxed too much or too little, because that raises this question of fairness, which people can disagree about. Yeah. But what we can say is they do pay, those other groups pay less tax than employees. And if you think we also want to encourage people to work as employees, then that's not necessarily a good system.
So for you think that the group that benefits the most is the ones that have diverse income that's not just income from being an employee. That's
right.
Right?
Yeah.
Because the employees get taxed the most, right?
Yeah.
And that could look like
and it's not just income tax.
Yeah.
The thing is, it sort of almost hides the total amount of tax that employees are paying, because they're paying income tax, they're also paying employee national insurance contributions, but then the employer is also paying employer national insurance contributions. That was the one that the government raised in the October budget.
Yeah.
And you might think, oh, well, that's okay because the business is paying it. But obviously, if the business is deciding how much they can afford to pay you, if they're paying more in employer national insurance contributions, that potentially is holding down your wage. Yeah. So economists would say, well, a lot of the incidents, what we call the incidents, like who bears the burden of employer national insurance contributions, is actually also on the employee. Yeah. So when you combine all of that, that's what means that the employees are paying the most tax of everyone.
Yeah. Is that generally, I feel like I can't help myself because I kind of have to ask it, but is that generally a good type of system where like the employee, and again, when we say good, I know it's very subjective. I guess what I'm trying to ask is does that make sense that, just the employees are paying such the higher amounts, even though they're the majority of, let me not say generate the most, but they are the workforce, right?
Yeah. I think what I would say is we don't want the tax system to distort people's decisions about how they work. So it's fine. Some people will be sort of quite happy to take a bit more risk. They've got some ideas. They want a bit more flexibility. Yeah. They might want to set up their own business, or they might want to be self-employed instead of being an employee. And that's fine. We should obviously have, there's room for different people to do different types of work. But I think, want people to take those decisions based on what their own sort of aptitudes are, what actually works well for them because of their skills and their other situation, rather than using the tax system as a lever to say we think you should set up a business instead of being an employee. Because that actually, some people make it's sort of, I think, a bit of a myth that all the innovation happens from startup businesses. Clearly that is an innovative sector, but there's innovation within big firms that employees come up with good ideas to do things as well. And so we don't necessarily want to be using the tax system to actively try to shift people out of employment into these other types of work.
That's interesting. And I would agree with you. you're absolutely right. If there's a squeeze on the employees, it's likely they're going to try and, they're going to find other ways to make more money. Of course, we can invest, you can buy property. But if, as you know, I've had this conversation a lot on the podcast, most people know that business is kind of the way to accelerate like your wealth building. And if you couple that with the fact that the taxes are lower in a way, you can understand why people will kind of look at it and opt to it. But you're right. Like, I guess why haven't they thought about this more? And why haven't they thought about, actually, you know what, why don't we try and keep employees more engaged, the highest performers, instead of them starting businesses, let's try and keep them, working, and then they can try and improve the businesses that we have,
Yeah, I mean, I think basically there's a lot of opportunities from setting up a business, but some people don't want to really run their own accounts, have their own whole, separate setup for doing all their paperwork and so on. And that's fine. They might actually be better off. They might work more efficiently in a company. I mean, I'm not saying that's definitely not going to be the case for everybody. The question is whether we want the tax system to be trying to shift everyone out of employment into these other types. Yeah.
So in terms of, exploiting the UK tax system, maybe let me not say exploit, but in a way, right? In what ways do the wealthiest individuals exploit the UK tax system?
Yeah. So, I mean, I think exploit is probably is like a little bit loaded because it suggests that people are doing something that they really shouldn't be doing. I think the most important point is that there's a lot of opportunities that the tax system gives that are not doing anything sort of against what the government wants you to do. It's just there are certain structures in the system, like the fact that we have a much lower tax rate for capital gains, that mean that if you can sort of shift your income into the form of capital gains, you've got a big incentive to do that. Whether you want to call that exploitation, I think naturally, if people have the opportunity, it's not sort of illegitimate for them to take that within the rules as they stand. I think it's more a policy question of whether we should design a system that kind of encourages people to do that.
Yeah, I mean, at the end of the day, right, if people are gonna, if it's legal and you could do it, people will do it, right? And if it's like, I can pay lower tax by doing this, people are going to do it. I don't see why they wouldn't, right? It's just,
Yeah. I mean, I think there's obviously some grey areas where it starts to be that the sort of scheme that you're involved in is very convoluted and is sort of playing with whether the application of the rules is actually giving you the tax treatment that you think it would. And that's what we would often call tax avoidance. Yeah. But sort of standard tax planning, I mean, at the most basic level, my choice to invest in an ISA rather than in some other savings account is saving me tax. I don't think anyone would call that exploiting the system. That's obviously what the government has created, the ISA system, to encourage people to do that.
Yeah. No, you're absolutely right. I think it's like where it goes, like really, like you say, they kind of where they design something where it's not really what it is. If you're in business and then you take advantages of the business, the fact that it's lower tax and stuff like that, that's very different to creating, I don't know, some shell, this and that, just to be like, oh yeah, if I have a pension, I can, that's very, very different kind of conversation. I think definitely, I do agree.
Yeah, so let me give you one example of where I think that sort of boundary is. So if you own your own business, then you can pay yourself dividends, but if you can afford to, you could actually just keep those profits inside the company, and at a later date when you sell the company, or even if you liquidate it in what's called a members voluntary liquidation, so a solvent liquidation, then you can take all that money out of the company at the capital gains tax rate. So that's much, much lower tax rate than you would otherwise pay. There's nothing to stop you doing that. I wouldn't call that avoidance. But what some people had been doing historically, because you can do that, is almost every year they would set up a company, roll all the profits up, close the company down, set up a new one, do it again.
Really?
And that was something called phoenixing, because you know the phoenix is like the bird that rises from the ashes again. So the company is sort of starting up again. And so there was some legislation in 2016 where the government sort of clamped down on that, called anti-phoenixing legislation. Wow. And so now if you do that, you are avoiding tax. In fact, you know, you would be underpaying your tax if you did that. But that was an area where, even though they've clamped down on the phoenixing, if what you want to do is you genuinely just want to retire after this, or you want to move back into employment, for example, there's still nothing to stop you from rolling your profits up and liquidating the company and getting the capital gains tax rate. And I would say that's not a good policy design that's encouraging people to do that, but it's not illegitimate for people to do it whilst it's allowed.
Okay, that phoenixing, what's the time limit for that? Because people could probably kind of argue that, like,
it's 2 years. 2 years. So basically, if you wouldn't be able to do that business yourself
year to year
for 2 years, then you could do it again if you wanted. So that's what the current rule is.
So basically, instead of 1 year, it's 2 years.
Well, it used to be that you didn't even need any break at all, because you could close one company down and straight away set up a new one. So year on year you could do it. Now you'd need 2 years where you weren't doing that business activity at all, and then you'd start again.
I wonder if people are still doing that even in new
We
rules.
have been trying to look at that, actually. Yeah, we haven't got results yet, but it is something that we're interested in.
Well, hopefully that's kind of like, discourage people from doing that kind of stuff. Okay, so obviously we talked about, I guess, possible, let me not say loopholes, but possible, using it to advantage, right? Even though that is the case, do you feel like the wealthiest pay their fair share of taxes? Because I think that is sometimes a conversation that people want to have.
I think there's, again, question about what counts as fair in this context. A lot of the time people will say, in fact, I've heard it recently on the radio, well, the top 1% of individuals by income pay 30% of all income tax revenue. That, I mean, that's true. It's a true fact. It's only looking at income tax and national insurance contributions, and obviously, we have a lot of other taxes like VAT and so on, which are not so shifted towards the top. But whether or not you think that that's fair, like, are they paying enough if that's how much they're paying? One point to make is, well, they pay a lot of tax because they have a lot of income. So the top 1% have about 15% of all income. So they're paying a greater share in tax than their share of income. But I wouldn't necessarily want to say, is that fair or not? I think a question we sort of can answer is, would it be possible to tax those individuals more? And that depends largely on how would they respond. So there's this worry that you could try to raise tax rates on people at the top, but they'll either find ways of avoiding it, or maybe, for example, they would leave the country. And so those sorts of questions are not so much like fairness questions, but they're just questions about, can we use the evidence to understand what would actually happen if we tried this? And that's mainly what my research team works on. And we're going to talk a little bit about that, because I do know that you did a few papers on that, like, kind of research, and I think that's quite important. That moment when you've just wrapped up a huge project, you're ready to celebrate a big payday, and then that sinking feeling hits you as you remember you need to create an invoice from scratch just to get paid. Here's the thing though, creating and sending out invoices shouldn't be painful, which is why I decided to use Invoice Home. They make invoicing effortless so you can get paid faster. With Invoice Home, you can create professional invoices in minutes, choose from hundreds of invoice template designs, and personalize them with your business logo. Once your invoice is ready, download a PDF copy or send it directly to your client via email. For even faster payment,
add a payment link to your invoices, allowing your clients to pay conveniently by card or PayPal. Now, if you happen to be traveling or away from your laptop, you can still create and access all of your invoices on your phone through the Invoice Home mobile app, keeping your business ticking along no matter where you are. The best part about Invoice Home is that they offer over 100 invoice template options for you to choose from for free, so you can try it out with no strings attached and see if it works for you. This episode is brought to you by Invoice Home, so if you're interested in trying out any of their free invoice templates, I've added a link in the description of this episode for you. Wealth inequality, right? That's a big topic at the moment, right? I guess, what are your thoughts on the role of the UK tax system in contributing to wealth inequality? Do you think it contributes to that? Is it something else that contributes to it? Or is it a number of reasons? I know it's a complicated question. There's probably not one specific answer. But yeah, trying to I think about that.
Obviously there's a set of forces, if you like, that result in initial wealth or income inequality that come from a lot of factors, like differences in people's opportunities, how much support have they had both financially and otherwise from their parents, sort of luck and other circumstances, education. There's lots of other inequalities that then contribute to wealth or income inequality. I think in relation to the tax system, if you just focus on income, then the tax system is progressive. That means, broadly people who are richer pay more tax, and that can redistribute income so that the level of inequality after tax is reduced compared with before tax. But actually, once you take into account all these other sources like capital gains, as I've mentioned, some of our research shows that the tax system does a lot less redistribution at the top than you would think. So the tax system is generally contributing to reducing inequality, but it's doing that a lot less than you would think because of these low tax rates on certain types of income and gains, which you're more likely to have if you're very wealthy. Yeah.
And you did a paper on capital gains and wealth inequality and the impact on inequality in the UK, actually. So you co-authored the paper in 2020. Can you share some of those insights, actually? Because I think that will be quite interesting to hear, because like you mentioned, right, on the income side, that redistribution is there. That makes sense, because as we all know, as you go up higher tax rate, we understand that. But on the capital gains side, a lot of people don't talk about that aspect. Can you kind of share some of those insights and
so what we were trying to do was dig into these inequality statistics, which for the period we were looking at, we were kind of focusing mainly on the 2010s. And if you recall, that was a time after the financial crisis when the government was taking a lot of steps to it was known as the austerity period, right? So they were cutting public spending, and that did affect, those public spending cuts did affect particularly people toward the bottom of the income distribution. But one of the defences that the government said at the time, this was under David Cameron and George Osborne, was, well, the official statistics that the Office for National Statistics produce is showing us that actually income inequality at the top hasn't got worse. So, the top 1%, their share of all income looked pretty much stable through that period. And I remember there were a lot of organisations at the time that, there were politicians saying, no, inequality must be going up. And then there were all these fact-checking organisations saying, well, official statistics actually show that inequality was fairly flat, so nothing to see here. But actually, those statistics are only capturing income. They're not capturing, for example, capital gains. And so what we did was we used the individual tax records. We accessed those. It's sort of de-identified, so we don't know specific individuals, but we can see the whole data from everyone who files a tax return. And we could actually combine how much income did they receive with also how much did they receive in capital gains. Right. And when you look at that fuller picture, actually it kind of changes the story of top-end inequality during that period of austerity. And it turns out that that top incomes, when you include capital gains in that measure, actually were increasing. I mean, not hugely, but they were going up during that period of austerity.
Okay.
And so I think, that's kind of an example where we have to be a little bit careful sometimes about statistics, even the statistics that are published by the Office for National Statistics, which are a very reputable organisation doing their best. But it is complicated, and exactly what you measure makes a difference to that. And so that was really what we were highlighting in the paper, is that the fact that we weren't counting capital gains was almost concealing this true story about the path of top income inequality in the UK in that quite important period.
Yeah, and that's this is the thing, and this is why I think literacy is so important, and why the podcast is so important for me to do, and that literacy, because when you have that lack of financial literacy, you would look at something like that and think, oh yeah, okay, you look at it and it will contradict how maybe people feel and say, well, hang on, I feel like I'm not gaining much, but those at the top seem to be gaining much. What's going on? I'm seeing, the Sunday Times rich list, and their money just keeps on going up. It's not going down. It's a new person. So how is that different? And then you kind of answered it. The answer is because of things like capital gains, of things like, dividends and stuff like that. All of that kind of stuff wasn't really considered, because obviously us as employees, we think only just in the income level, just to see the income tax.
Yeah,
right?
I mean, I think another one that's quite important that we really don't have good statistics on even now is gifts and inheritances.
Yeah.
So, I mean, we do have an inheritance tax, but that's measuring how much tax is paid by people who die. We don't actually record where that money goes, who it goes to, or at least the government doesn't have the statistics on that. So they rely on surveys, basically like asking a sample of people, did you receive any gifts? But there's a lot of problems with surveys. If you can imagine, you're asking really rich people surveys, they're probably not necessarily going to spend the time to answer them.
Definitely not.
And so it's an area where the truth is we don't actually know that much about the impact of gifts and inheritances on inequality, partly because we're not able to measure them all that reliably.
Yeah. It's interesting because you did say to me when we spoke offline that a lot of this data in terms of even at the wealthiest is really lacking. So even getting that true picture is very, very challenging. And coupled with the fact in the UK, we don't like to talk about money, right? We don't talk about money. So coupled with the fact we don't talk about money, the data is not there. We don't even really have the true picture. We try our best. And I know that you've done more research, which I want to talk about, because I think it's very valuable research. So I wanted to move on to taxing the wealthy, right? So again, I know you and your team conducted research on wealth tax. Could you share some of those key findings from that study?
Yeah, so just first of all to say a bit about what a wealth tax is. So the idea of a wealth tax is we sort of add up the value of all of the assets that you have. We take off all the liabilities. Okay, so if I own a house but I also have a mortgage on that, then the net value of that would be, the value of the house minus the mortgage debt that I haven't repaid yet. But we do that across all your assets, and we work out what's your net total wealth after liabilities. And then the idea of a wealth tax is that you would pay a tax based on a percentage of that wealth. Typically, I mean, some countries do have a wealth tax already. The UK doesn't, but amongst the countries that do, it would be at a level of sort of typically less than 1% of your wealth per year.
Okay, wow, that's a lot.
But that is still, potentially, if you're not actually receiving very large returns on your wealth, if you stick your money in a bank account at the moment, you might be able to get, say, 4.5% or something interest. But if you were paying a 1% tax on that, then in some sense it's kind of equivalent to say a 20 or 25% tax on the return on that wealth. So, but I mean, most the research that we did looked at whether introducing a wealth tax in the UK would be a good idea. And we looked at both this idea of a one-off wealth tax, so not recurring every year. This was actually, we looked at this during COVID when there was a lot of concern, obviously, about the long-term public finance impact of all the massive expenditure that happened during COVID, putting people on furlough and so on. And we thought about a one-off wealth tax as a potential way of paying for some of those costs. But then we also looked at this idea of an annual wealth tax, so it would recur each year. And well, basically our conclusion on the annual wealth tax was it would probably be a better idea to fix some of our existing taxes on wealth first before you set up a whole new tax. But we did say that there was a case potentially for having a wealth tax at above a high level of wealth. So we said around a sort of £10 million threshold, that then even if you were to fix all these other taxes, if your policy objective, and we weren't really saying whether you should or shouldn't want this, but if your policy objective was to reduce that top end inequality, then a wealth tax above £10 million would potentially be an effective way of doing that.
Okay. Wow. There's so many parts of the follow-up questions that I definitely have around that. I guess my first question that I would want to know is, what would be the other things that would need to be fixed first before introducing a wealth tax? That's one. And then I'll ask the others. I don't want to...
Good question. So the capital gains one that I've mentioned, so introduce an investment allowance but increase the rates of capital gains tax. We should apply some kind of equivalent of national insurance contributions on other forms of investment income, because at the moment you pay national insurance contributions for income you get from work, but not from income that you get from investments. So we could equalise that. I mean, there are lots of reforms you could do to inheritance tax. Actually, in the most recent budget, the government did, we probably heard from in relation to farmers, what some of those changes were, reducing or capping the amount of relief that you can get for certain types of wealth with inheritance tax. But there are actually more kind of structural changes that you could make to inheritance tax. Other countries, for example, rather than taxing the person who's died based on the amount given away, instead of doing that, you could tax the amount that each inheritor receives. So Ireland, for example, has a tax called a lifetime accessions tax or lifetime receipts tax, which is based on the amount that you receive. There are various arguments for why that might be a better system than what we have currently. We could reform council tax, so we could do that revaluation, and we could add bands at the top. So those are all things which would be reforms to our current system of taxes on wealth. And obviously none of them are easy, in the sense that we've already talked about some of the political challenges with doing that, but they're sort of more incremental changes from where we are already. So administratively they're potentially simpler than creating an entire new tax.
I understand. So you think it makes more sense to fix those things, fix the current issues with our current tax system, rather than let's just create this new wealth tax, because actually those things have got problems. Actually, if you fix that, those things could be equivalent to if you did that, and actually makes more sense. And
I mean, the idea of a wealth tax is a very sort of polarizing idea. I think some people think, it could never work. It's been tried in other countries and it didn't work. It wouldn't raise any money. Everyone would leave or avoid it and so on. That's one extreme view. The other view that some people have is, wealth tax is a solution to all of our problems. If only we had a wealth tax, we wouldn't need to make all these other difficult policy choices that the government is having to make. I think I wouldn't position myself at either end of those. I think the truth is that there is a potential case for a wealth tax, and I think there are ways that you could design that effectively so that it would work. It would be difficult to avoid. And the evidence about whether people would leave suggests actually quite often that's exaggerated. On the other hand, an annual wealth tax, if you were to set the threshold at 10 million, wealth above 10 million pounds, and if, for example, you set that at a 1% rate, we estimated that could raise about 10 billion pounds per year. Yeah, I mean, in one sense, that is big money. Depends sort of what your reference point is. So, you know, the total cost of education in the UK, all the budget for schools, is a bit over 100 billion. So 10 billion, you know, it's not nothing. The NHS costs almost 200 billion, right? So we're not talking something that's going to completely solve all of our other problems. On the other hand, to raise 10 billion pounds from income tax, you'd need to put up the basic rate by between 1 or 2p. So, you know, that people are going to feel that kind of tax increase if you're in work. So I think that's kind of where I'm at. There is a case for a wealth tax, and I don't agree with those who say it could never work, or that it would be kind of the apocalypse if we try to do this. On the other hand, I think people who think that a wealth tax could sort of solve all of our other problems, and we could avoid difficult choices in the rest of public spending or other tax, or we could give everyone a huge tax cut. I don't think that the kind of money is there for that.
Okay, fair, I understand. So you're saying a wealth tax is possible, but actually what's more important right now is to fix the current issues with it. But if we were thinking of a wealth tax, then it would be this kind of annual 1% with people with assets above kind of like 10 million, of course, minus liability. So assets, of course, after liabilities over 10 million, and we tax them with 1% every year, which kind of makes sense. But even then, that's only generating 10 billion, which isn't a small amount, but it's not going to solve a lot of the issues people talk about, like the NHS or other kind of things, which is a fair point. Because actually, I did have a question that I wanted to ask you about. You know, people thinking that the wealth tax would be, could solve it. What if, playing as devil's advocate, instead of 1%, it was 3%? At that point, is that like, wow, that's crazy? That's really going to make people be like, okay, I'm leaving.
I think the way to think about a wealth tax like that is if you were to translate it into a tax on income, depending on your assumption about how much return people can get from that wealth, how high is it? By the time you get to 3%, I mean, it should still be possible to pay it out of your income, because really, if you've got a lot of wealth, you should be able to invest it at a rate of return better than 3% at the moment. On the other hand, it is quite a sizable chunk of that. There aren't any countries in the world that have or have had an annual wealth tax as high as 3%. So I think we would be in fairly uncharted territory at that point.
Right.
So, I mean, whether people would leave, I mean, there are things that you can do about people leaving, which we'll get to. On the other hand, that is certainly the kind of tax increase that would make people, that would be much more significant even than all the debates we're having currently about changes to the non-dom tax regime and so on.
Right. Okay. So something that high could change people. So what is the highest in the world? Is it 1%?
Yeah. So there's sort of a few countries have a wealth tax currently. So Switzerland does, Norway does, and Spain. I always find that kind of an interesting list because those are quite different economies, quite different countries. You wouldn't necessarily people often think of Switzerland as a low tax jurisdiction, but they have a wealth tax. Yeah. And they do have, or some regions, some cantons do have an inheritance tax, but it's often quite exempted for a lot of people. So they have a quite odd, or very different from the UK system of taxes on wealth, because they have a wealth tax but not these other taxes. I think, as far as I know, the countries that have the highest rates, Norway and Spain have higher rates than Switzerland.
And in the 10 million threshold, what was the rationale?
Yeah, good
that?
question. So obviously the higher you set that threshold, you know, you're making sure that people on lower levels of wealth are not affected by this. But more importantly, that choice of threshold is actually driven by the administrative costs in relation to how much tax you would raise. Because the thing about a wealth tax is, obviously, to levy that tax, you need to be able to value people's assets, because you need to know how much net wealth they have.
Yeah.
And for some things, that's quite straightforward. Like if you've got a bank account, we can just look at the balance and see how much it's worth. Even if it's property, you know, you can get quite a good valuation. People know how to do that sensibly. Like Zoopla's going to give you not a terrible estimate. It's not always right, but it's, you know, you wouldn't use that for tax purposes, but it's quite possible. Where it gets much more difficult is your startup business, which isn't making that much profit, but is trying to get investment and, you know, is potentially very valuable. How do you value those kinds of business? And that is quite a complicated and expensive process. And the thing is, if you start to levy tax on at a low threshold, you're incurring all those costs of valuation, but you're not actually raising that much tax from those people. Yeah. So it's sort of only at higher levels of wealth where the costs of valuation become worthwhile to make the tax kind of efficient. Okay,
that's a great answer. Thanks for explaining that, because I think, again, when we talk about blank statements of let's do a wealth tax, the way you've broken it down really shows why it's not just about, it's not that we don't want to, but what's the cost benefit of doing this? Because like you say, if we're going to tax people, how are we going to find out how much they tax? Because not everybody, like you say, has just money in a bank, right? A lot of people have their money in assets. And you have to value those assets, and somebody's going to have to value those assets every year. How do you kind of do that, right? And how do you make sure it's accurate and on whose kind of like data you use it?
And I think that actually explains in a lot of cases what's gone wrong in other countries. So the one thing you hear very often with wealth tax is, well, lots of other countries have tried it and it didn't work, and that shows it can't work.
Yeah.
When we looked into this and we did a big kind of cross-country study, we got lots of practitioners involved from other countries as well to relay what was going on in other countries. And the story of the kind of decline or failure of wealth taxes in other countries is often triggered in sort of small steps by saying, well, this asset's quite hard to value. Instead of valuing it properly, should we just use some kind of approximate formula? Then people start to game that. Then other people say, well, that's really unfair. And so you start to erode the tax because there's all this special pleading that means the government decides to exempt certain types of asset or give them special valuations to try and make things easier. And the story of the decline has often been, once you go down that road of exempting some assets or giving them special valuation treatment, you start to introduce all these distortions in how people invest. It doesn't raise as much revenue. And in the end, you get to the point where you say, is this really worth it? It's not raising very much revenue. And it's not, people think it's unfair because, you know, it doesn't apply equally to everybody. Yeah. And that's when the tax gets abolished. So one lesson you could learn from that is, it's failed in other countries. The lesson that we took was, if you're going to have a wealth tax, it's absolutely essential that you apply it to all types of asset equally, and that you do the valuations properly. And that can be somewhat tricky for some types of asset, and that's why we suggest a high threshold where the only people who are having to do valuations, there is at least a lot of tax at stake, and so it's worth doing.
Okay, I get it. Yeah, that puts it into context. And again, this explains why this stuff is not as straightforward as people, you know, think it is. In places like you mentioned, Switzerland have a wealth tax, Norway and Spain. Why do you think it works there and they haven't abolished it?
Yeah. Well, there has been some controversy about Norway increased its wealth tax recently. And there was there's a lot of reports about billionaires fleeing Norway. interestingly, all the reports said they were going to Switzerland, which is odd when you think Switzerland also has a wealth tax. But actually, we looked into this and it turned out that was not mostly driven by changes in the wealth tax, but actually changes in this exit tax that Norway also has. So that's an example where you have to be a bit careful sometimes about using these examples from other countries, because it's quite easy to misunderstand what's really going on. Switzerland has quite a different wealth tax. It has lower rates, but it applies much more broadly. And so Switzerland's wealth tax is actually quite different from Norway's and Spain's.
Okay, cool. Thank you. So again, talking about this wealth inequality, right? Do you think the approach that you've talked about, do you think it could help to address that issue, right? Because many believe obviously that wealth inequality is here. We know that it happens, but it's going to continue to grow. Do you think a wealth tax, the introduction of a wealth tax, could help narrow that?
I think if you had a wealth tax at a high threshold of wealth, as we were suggesting, then it would potentially take the edge off the very top end inequality. Okay. Depending on what the government then did with that revenue, obviously, if it used it in programs, public spending programs that particularly funded services that benefit those toward the bottom of the income distribution, then it could also have an inequality reducing effect like that. But I think, again, I would be cautious about saying that would be transformative. It wouldn't suddenly solve all of our wealth inequality problems, because a lot of that wealth inequality is driven by these things like differences in people's early opportunities and their education and so on, which, the tax system can only go so far to correcting after the fact.
Yeah, and that's the thing. Again, I think a lot of people, sometimes, you have to be mindful of how do I say this? I know that there's a wealth inequality. We all know that there's a wealth inequality. I think there are several factors to it, but I think sometimes when I think that when these inequalities are there, I think people try to maybe convince that, okay, if we tax the wealthy, then your life would be better. Is that kind of rhetoric, when I don't think it's just as easy as that?
Yeah, I mean, I would definitely agree that it's not the sort of solution to all of our problems. Yeah. On the other hand, we kind of know that the government is having to make very difficult choices about public spending. They've just announced all these cuts, for example, to disability benefits. And I think those cuts are aimed at saving about £5 billion per year by the end of this Parliament. So, as I mentioned, a wealth tax above 10 million, that could potentially raise 1%, could potentially raise 10 billion. So it's not going to pay for all of the NHS, but if the government's making other difficult choices, then there are things that I think the government could do to raise more tax. And so the choice not to do those things and to do things like cutting disability benefits or whatever other hard choices they've made, those are political choices, obviously. Yeah.
So you were recently interviewed by The Times, and I know we also talked about this as well, and asks, should expats be charged an exit fee? And I think when you mentioned it to me when we spoke, that was the first time I had heard of an exit fee, right? Could you explain what an exit fee is and share your thoughts on, that topic?
Yeah, so pretty much all countries that have something like an exit tax, they have it on capital gains. And there's a particular reason for that. So the idea of an exit fee is not trying to stop people from leaving. I would say it's more like saying you can leave, but you need to pay your bill on the way out. Okay, so why is that in relation to capital gains? So when you own an asset and it goes up in value, you normally only pay capital gains tax when you sell that asset. Yeah. But if you lived in the UK and have made a big gain, so while you're living in the UK, maybe you've started a business and the shares have gone up a lot in value. If you leave the UK and become non-resident for tax purposes before you sell that asset, then you potentially pay no UK tax on that gain. And I think some people would think that that is kind of unfair in the sense that you were benefiting from all the UK's sort of infrastructure and education and so on when you built this business. And it's not about saying we're trying to stop you from leaving or punishing you for leaving or anything like that. It's just saying when you leave, you need to sort of settle up the bill on the gains that you've accrued at the time when you leave before you exit. And so, I mean, when we looked into this as a research team, actually, to be honest, an exit tax sounded like a bit of a kind of far out idea, like radical, if you like.
Okay.
And then as we started looking more into what other countries do, what actually really surprised us is that the UK is the outlier in not having any kind of exit tax at the moment. So of the G7 countries, actually only the UK and Italy don't have any kind of exit tax.
Seriously?
All the other countries do. The US is a bit different because I don't know if you know, the US taxes people based on citizenship, not based on residence. So if you're a US citizen, you have to pay taxes wherever in the world you're
Anywhere
living.
in the world,
Unless you renounce your citizenship, then you can get out of US taxation. But the US has an exit tax if you renounce your citizenship. So, and based on this same idea of what's called is a deemed disposal for capital gains tax purposes. So it's sort of treating you as if you'd sold all your assets at that time, even though you actually haven't, but you're leaving the tax system. So the US has an exit tax already. And most of these G7 countries do. And the UK is kind of unusual in not having something like that.
That's so interesting that everywhere else has it, right? Apart from like some of the more, some of the, like you said, G7, right? It's so interesting that they don't have it, right? And is that a problem in any of these problems? Are people trying to get rid of that? Because we don't have it, right? And I'm trying to also understand why we don't as well.
So part of the reason why the UK hasn't had an exit tax is because when we were in the EU, it was quite difficult to make exit taxes work. So actually France and Germany do have an exit tax, but the EU had imposed various restrictions on how that worked because of the EU principle of free movement.
Okay.
So it was actually, for a while at least, effectively contrary to EU law to have an exit tax.
Yeah.
So whilst the UK was in the EU, we didn't really have that much freedom to have an exit tax, even if we wanted.
Okay.
So you could think of an exit tax like one of these Brexit dividends. Like now we've Brexited, we would be free to have an exit tax if we want to have one. I mean, there are tricky kind of administrative issues. How do you make this work? But I think the best model, the one that we would say, is this thing called rebasing on arrival and deemed disposal on departure. So what that means is if you come to the UK from abroad, if you've been living somewhere else, the UK is not going to try and tax the gains you made before you arrived. So that's what this rebasing on arrival does. And then it's saying, but if you leave the UK, you should pay tax on the gains you made while you were living here. So it's sort of intended to work in both directions. It's not trying to tax people who are arriving on their pre-arrival gains, but it is taxing people who leave on the gains they made while they were here. And so that system is already in operation in Canada and Australia. That's what they do.
Right.
And that's kind of potentially a model for the UK.
Right. Well, people are probably listening to this like, really? We're thinking about introducing another tax, Atto and Andy? No way. No, we don't want no more taxes. I guess, does it make sense to introduce an exit tax given the amount of taxes we already have here in the UK?
I think there's there's quite a lot of revenue at stake. So again, it's about choices, really. I
Yeah.
mean, in some sense, obviously, nobody likes paying more tax, but obviously, we need to raise tax revenue in order to fund public services. And if we're not going to raise the tax from these people, implicitly, if we want to have the same level of public spending, we're going to have to raise it from someone else. So the way I would think of it is, perhaps you wouldn't ideally have, another. It's not really another tax because it's sort of it's extending the application of our capital gains tax rather than a totally new tax. But maybe we'd like to have less taxes. But another way of putting it is, if we're going to have to tax some people, would it be better to tax the people who are leaving on the gains that they made before they left?
Okay. And that you don't think it would kind of discourage people coming to the UK and contributing to the economy? Because that's what I'm thinking, right? Like, maybe people are thinking, okay, the UK doesn't have an exit tax. You're right. Yes, it's also like maybe potentially thinking, oh, okay, I can go there, build something up and then leave without any tax. But then, having said that, they could potentially be also contributing to the economy when they come here, employ people, etc.
Yeah. So we have thought quite hard about those, like what we call migration responses. How would people change their behaviours? I think the first thing to point out is that our current tax system is actively incentivising people to leave the UK. If you've made a big gain in the UK and you want to save tax, the easiest way to do that actually is not through tax schemes, but to go and live abroad when you sell that asset. There is a rule that if you come back within 5 years, then you have to pay the tax at that point. But that's almost perversely encouraging people to leave forever rather than come back, which is also not good for our economy. So if you're thinking about, we want to attract and retain these talented or business people in the UK, our current system is sort of effectively saying to people, before you sell, or if you've made all these gains, you could avoid paying tax by leaving. So that is not a good incentive in that direction.
Yeah.
I think it is fair to say maybe there are some people who are coming to the UK currently who like the idea that there is no exit tax, but it's actually only an advantage to them if they were planning on leaving again before selling, because if they're still here when they sell, they would pay capital gains tax. So no, I mean those decisions, those behavioural responses are both complicated, and also we don't have a great evidence base on what people would do. So it is a valid concern, I think. But the work that we have done indicates that you could raise fairly substantial revenue from having an exit tax. Okay. So definitely opportunities. But you know what? Now that you put it like that, you are right. You're right. It's kind of incentivizing people to leave, which is not what you want for an economy. You want to keep your best talent, and you want to incentivize them to stay and contribute to the economy. So it's such an interesting area. So we talked a little bit about this, right? But I want to kind of get your overall answer on this. Is the current UK tax system truly suited to the needs of our economy, or is it outdated and in need of reform? I would say outdated in lots of respects, in the quite literal sense that, as I mentioned earlier, we have a lot of rules not for any really good economic reason, or not any reason anyone could defend, but just because we've had those rules for a long time. And so I think it's always worth thinking with rules that have been on the books, in some cases for literally centuries, is this still the way we want things to work? I think there is a general sort of small c conservative, so I don't mean that in the political sense, but just cautious approach to tax policy that means that rules stick, tax rules stick around for a long way past their sell-by date because people are too cautious, or there isn't enough political bandwidth to change them, and that has kind of hidden costs. So I think politicians see all the uproar that they get when they try to make tax changes, and sometimes shy away from doing that. But they don't really see all the sort of ongoing hidden costs from having rules that haven't really been reviewed properly in a long time.
Yeah, and what do you think those hidden costs are, kind of like, by not?
Yeah, so I think, I mean, economists would talk about distortions to people's behaviours. So basically, people doing things because of the tax advantage rather than because that's good for other reasons. And so that can be bad for economic growth because it's sort of misallocating, kind of sending people to do the wrong things effectively. And those kinds of costs, sometimes they're quite hard to measure, but they are definitely real. And, you know, when people talk about, there's a lot of sort of amateur advice about tax, right? People say, oh, you could do this, but if you do it this way, you'll pay less tax. Those sorts of things that people talk about that's impacting their behaviours, unless sometimes there's a conscious case the government has for, like, we want to incentivise this activity, so we're going to give it a tax break, or we want to disincentivise people from doing something like pollution or whatever, so we're going to tax that more. Those sorts of things where it's a conscious choice that you're trying to influence people's behaviours, that's one thing. But if you just sort of haven't reviewed a policy and it's having all these effects that are actually unintended and which aren't good for the economy, then I think there's a case for reviewing those.
Okay, that makes sense. And when you were saying that, that makes me think of things like pensions, right? Which the incentive for the government in pensions is, oh yeah, we'll give you tax breaks if you invest in your own pension, so we don't need to take care of you, right? That's what they're probably thinking. They'll never come out and say that.
Yeah, I mean, the pensions one's quite a good example because I think there are good reasons why we give tax relief on pensions, because essentially what we're doing is we're not taxing you when you put money into a pension, but we tax you when you take the money out of the pension. So, but the cost of as an incentive, the cost of those tax breaks is very large, when actually by far the biggest change that's happened in pensions in terms of savings rates has been auto enrollment. So just flipping that default so that people who aren't really thinking about it, they're automatically saving in a pension. That, you know, in some sense that shouldn't make a difference. If everyone's already planning this carefully, then they'll choose one way or the other. But auto enrollment has had a much bigger impact, or at a much lower cost than probably an extra tax break would have done. So interesting, because that's when you're talking about incentivizing, that's what I was thinking about pensions, right? But you're right, like the auto enrollment, it's because of the friction of finance. I did some research on that, and it's a lot of that, because with pensions it's complicated choosing your investments. But if your employer, it doesn't mean that people are investing in the right pension. That's a different conversation, and I've had that conversation. But they are in a pension, because they're almost like you mentioned, right? As soon as you join your employer, it's like you feel like you're getting a form to fill out, and then you kind of get started with it. So those things happen. So we talked about implementing a wealth tax. You talked about some of the other changes that you can kind of make, such as the investment allowance. Was there any other kind of changes that you think would be needed in the UK tax system? I think those big ones are moving towards equalising tax rates across all different forms of income. I think that's a big one. And if we could grapple with council tax, I know it's politically a bit of a hot potato, but if we could grapple with council tax, then potentially we could make a lot of improvements there as well.
And what do you think the impact of these changes could be? Because I guess we're talking about tax, we're talking about making these changes, but what could the impact be for people, and just the UK and things like that?
I think the main impact, there's two sort of really. It's improving efficiency in our economy and stopping these situations where people are making decisions mostly for tax reasons rather than because of, other factors to do with the skills that they have and how much appetite for risk they have and so on. That's one part of it. And the other is that there is opportunity to raise additional revenue, and we know that at the moment public finances are particularly stretched. And I think, going back to your earlier point, in one sense, nobody likes paying more tax, but also we should always think, well, if we're not going to have this tax, then, you know, what public spending is going to be cut, or who else is paying more tax instead? Because those are, in practice, the choices that the government faces.
Yeah. It's interesting because when I think about somewhere like the UK, and I think about places like Dubai, low tax, think about Switzerland, low tax, right? It's lower tax, a bit more expensive, but I think maybe people sometimes in the UK feel like, okay, I'm paying all this tax. Yes, we've got public services, but they're not up to scratch. Maybe I would rather pay low tax, and then I have a choice of, there's no right or wrong answer, but maybe I have a choice of how I'm spending, whether I have to pay for private healthcare, or, you know, I have to pay more for other aspects as well. Probably, I think that's maybe how people sometimes maybe feel about this stuff.
Yeah, and I mean, there's obviously a valid question about sort of how efficiently public services get delivered, and that definitely matters in terms of people's willingness to pay tax. I think clearly there is quite a bit of variation across countries, and I think one of my concerns I have when people say, you know, the UK collects, what is it, getting towards 40% of GDP in tax revenue, other countries collect more or less. Comparing across countries is quite difficult because, just like you just said, you know, there are other countries where you pay less tax, but you don't have any free healthcare, so you have to pay for your own private health insurance, and that is a cost then that you're not paying tax, but you're incurring a different cost. So it can be the grass being greener on the other side. I'm definitely not saying the UK has the kind of the perfect right mix, but it's difficult sometimes to compare the UK's tax rates with other countries unless you're also comparing what public services and other things are available. Yeah.
Do you think there's a world where it would work with lowering income tax here? Do you think that could work? Because obviously it's because you said a lot of it, and I want to actually explore this a little bit. You said a lot of this, obviously a lot of our tax, I'm not just talking about income tax, a lot of them, even now, they're not for economical reasons. It's just because we've had them. It's just from the past, which makes sense, right? I think a lot of what we do today is because of the past, you know, law and all that sort of stuff. So do you think a lower income tax rate could work here in our current tax system?
You would, for that to be the case, you would have to believe that people's behavioural responses are quite large. Okay, so what I mean by that is there is this, I don't know, have you ever heard of the Laffer effect? So there's famously an economist called Arthur Laffer wrote this curve on the back of a napkin for Ronald Reagan, which explains this idea that there's a revenue maximizing rate of tax, and if you raise tax rates too high, you could actually end up getting less revenue. And so in theory that is definitely true, but whether you could actually have a system which, certainly whether it could raise more revenue if you lowered tax rates, would only occur if people really responded a lot to that tax cut and decided, I'm going to work a lot more, or we're going to suddenly get lots more people coming to the UK. And the evidence isn't really there to suggest that behavioural responses generally are that large. What I think the evidence generally shows is, like we talked about earlier, if there's an opportunity to do something with your accountant that will reduce your tax bill and it's relatively costless for you to do, then lots of people will do it. So clearly people are very responsive when it comes to tax planning. But most of the evidence, it doesn't all go this way, but a lot of the time people's what we call real behavioural responses, will they actually decide to choose to do less hours or not take on this job or leave the country? Clearly people do that to some extent, but those responses are not large enough to sort of offset all the revenue that you're losing from taxing at lower rates.
Okay. That makes sense. Yeah, now that's interesting. That's the thing, is balancing the scales where you can kind of do things. Okay, so we talked about this, right? But I just want to kind of hammer it home for people, right? So again, I think is a good way to almost end the podcast. So how does the way you receive your income impact the taxes you pay, and how can understanding this help you minimize your tax liability? Yeah. I feel like I'm helping people, but to be fair, I think we always try and help people in what ways, what's helpful for them. But
so I guess, taking my tax policy hat off, where I would say we probably shouldn't have a system where it's possible to do that kind of tax planning. I mean, under our current tax system, diversifying your income, I mean, what I mean by that is there are separate allowances currently there's a trading allowance, there's a savings allowance, there's a dividend allowance, there's capital gains allowance, and all of those are separate and additional from your basic personal allowance. And so if you are in a position, and a lot of people aren't, because if you're mostly getting your income from an employer, you can't do this. But if you're in a position to diversify your sources of income so you can make use of all of those separate allowances, then it does potentially give you quite a large tax saving. So I mean, I don't necessarily advocate for a system that enables you to do that, but in our current system, there's nothing wrong with doing that. What you were saying, you enable a system that doesn't do that. But holistically, then what should the system do, would you say, at a high level? I mean, I think we should move towards a system where it matters less or not at all, like where you get your income and gains from. And so actually, in some ways, that would be a much simpler tax system as well. Because at the moment, we have a lot of tax rules that are trying to police the boundary between these different types of income because there's such a tax difference depending on what you have. Under a system where whatever type of income you get, you would pay the same effective tax rate. We could get rid of quite a few of those rules because we wouldn't need to police these boundaries because they wouldn't make a difference anymore. So there is a sort of tax simplification case for moving in that direction as well.
Is there anywhere in the world that does something that simple, or is everybody the same like us, just using historical tax?
Good question. There's some I would not say there's any country that gets sort of everything right, but
like that specific one where it's like just the one tax across everything.
No country that I'm aware of does exactly that, but Denmark is probably quite close. I mean, they have higher levels of tax overall, and I'm not necessarily saying we should have higher rates of tax. I'm just saying we could do this in a revenue neutral way, so when we align it, we could use the revenue we're getting from the ones we're raising to cut tax for the others. So
no, honestly, this has been such an interesting conversation. I feel like I've definitely have an even better understanding of the tax system, and even just the reasons for why certain things are the way they are, and even like the wealth tax, like that, does that even happen? So I know you co-authored multiple papers on the likelihood of the super rich migrating due to tax reasons. And I think that is another question that you've been seeing around. If we increase tax, they're going to leave. So we've got 10, I think it was the number, 10,000 millionaires have left, and stuff like that. All this kind of stuff is just a lot.
I hate that statistic, particularly. That one is rubbish. But
this is a lot it's making it seem like everybody's leaving and nobody's in the UK. Central London's still thriving, businesses are still thriving. So, what's kind of happening there? So, and also in that, those papers, you also were looking at the likelihood again of super rich migrating due to tax reasons and what factors they actually value, right? So specifically, you and your team interviewed 35 of the wealthiest 1% in the UK. What key findings did you uncover from that research?
So I've worked on quite a few different projects that are trying to get at this question about will everyone leave. And you mentioned that statistic about the 10,000. Something that we need to sort of unpack a bit with that is it's based actually on LinkedIn data. And actually, although they say 10,000 people would leave, it's based on a sample. So what the data is actually underlying this is 100 people changed their location on their LinkedIn profile. That's what that statistic is actually based on. And so that's why I find it a bit frustrating, because we have done research we did those interviews, but we've also done research using tax records that we accessed from HMRC, the tax authority. And so we looked at whether people actually changed their tax residence following this big reform to the non-dom regime. I don't know how much you know about that, but sort of there have been these reforms very recently in the last budget. But before that, back in 2017, there was a reform that removed the tax advantages of non-dom status for just a kind of subset of those individuals. And we looked at the response to that reform. And at the time, it was maybe not quite as many people were making as much noise about it as they are now with these latest reforms. But a lot of people at the time said, well, if you remove this tax break for this group back in 2017, they'll all leave. And so we looked at that question with the tax records, did they actually leave? And what we found was there was some immigration response. So I think it's wrong to say, nobody leaves. We found that the emigration rate of that group went up from about 5% to 10% as a result of the reform. So you could say, well, that's doubled. Yeah. But obviously from a relatively low base, so 5% percentage points extra people left. But obviously everybody who stayed paid considerably more tax, and we measured that overall they paid 50% extra tax, so a lot more tax was paid by those who stayed, and yet they didn't leave. So I think, again, I don't agree with those who say, we could just raise taxes as high as we want and no one will do anything. Some extra people will leave. On the other hand, these sort of claims, which are often made by, in the newspaper by people associated with wealthy individuals who are saying, everyone's getting on their private jets. I think that is probably exaggerated. But we will have to see with the most recent reforms. They are some of the most significant reforms. These latest non-dom reforms are some of the biggest reforms to taxes on very wealthy people in the UK that we've seen for a very long time. So we will have to see how that pans out. But I would not trust the LinkedIn statistic.
That is crazy. That's great. So, I think thanks so much for sharing that data, because I think it's quite important for people to kind of understand that, yes, you're right. With any kind of change, some people will say, okay, look, I can't accept that change. But the vast majority were happy to say, okay, we can pay a bit more. It's, yes, nobody wants to pay more, but we can afford it. It's, we still have a lot more money left.
And actually, out of those interviews that I mentioned, the thing that came out really strongly was that there's a lot of things that people really like about London. It was actually quite London specific amongst this really wealthy group, that London is like a globally attractive city. And the way that I would think of it is, London is a premium product for which a lot of wealthy people are just willing to pay a premium price. I mean, they might be slightly upset that it's more expensive than it was, but one of the nice things about being rich is you can afford to live where you actually want, rather than where we'll offer you the lowest taxes.
That's true. That's a very good point. The way you said that, yes, you're absolutely right. You can decide. Absolutely. And in terms of what they valued, what was like the indication of what they kind of value, if it wasn't like, taxes and stuff like that?
A lot of people talked about all the sort of cultural things that London has to offer. So actually, quite sort of highbrow things like going to the opera or going to the theatre, those kinds of things, but potentially also, all major sports events and things. Just, I think the sense that London also is a kind of metropolis, if you like, where, there's a lot of action and there's a lot of other highly globally connected wealthy individuals, and so sort of socially it's the circles that you want to move in. And I think that's probably quite intuitive to a lot of people about why you would like to live in London. They were also very disparaging of tax havens, more than we were expecting.
Okay, interesting.
So we got two separate interviewees who said that they thought about going to Switzerland, but it's too boring. I quite like Switzerland personally. My grandmother was Swiss, so I'm a quarter Swiss.
Okay.
So, but apparently Switzerland is too boring if you're used to London. So.
Too boring for the tax break, so it's not worth it. And you see, this is the thing. I think what this boils down to is not always about the money. Yeah. When you boil it down, I think, and I think this is true for at any levels. It's more about your happiness. Yes, it's maybe they're paying more, but it's like, okay, if I weigh up paying more versus me moving my whole lifestyle to somewhere else, does it even match what I really want?
Yeah.
I'll pay the more.
So with the most recent reforms, that's where I'm a little bit skeptical that we can know at this point, because I think what also came out from these interviews is the process of moving is quite a long one. Your initial reaction is, oh, the UK's, really annoyed me with this, I'm going to leave. But then you sort of think, well, where actually else am I going to go? Does my partner also want to go there? If I've got kids in school, am I going to take them out of school and move them? And so I'm not sure if people may still actually be deciding, and not everyone who sort of has loudly said, right, that's it, I'm leaving, will end up actually going. Yeah,
that's the thing. It's so much more complicated than, we're just leaving because of tax, or we just move to somewhere else because of tax. Is way more multifaceted than that. Thank you so much, Andy. This has been a great conversation. I feel like we've learned so much about the tax system, potentially implementing wealth taxes, what kind of changes we can kind of make, and how the wealthy actually truly think about some of these kind of things. I think it's quite important to know. Where can people find you, obviously, if they want to read more of your work and check out your stuff as well? Yeah,
so best place to find our work is on our CenTax website, so Centre for Analysis of Taxation, and our website is www.centax.org.uk. So that's where you'll find all the research, things that I've been mentioning on the podcast just now. And yeah, if you're interested and you want to know more, then do get in touch with our team.
Amazing. Thanks so much. Like I said, I really, really appreciate it, because I feel like I have, like I said, a better understanding of the tax system. And I do agree. I think you're right. If there's a way to incentivize people to do what they truly want to do, rather than thinking about, okay, how can I, get more of an income by lowering my taxes? I think if we can kind of move more towards that type of system, and maybe lower overall taxes generally as well, because everybody's paying more, then I think that would be quite a nice. I don't think you can ever get it perfect. People are going to always complain, but I think that would be quite nice. Do you have any final words for the watchers and listeners?
Just to say thanks very much for having me on, and I've really enjoyed the conversation.
Thank you. Thank you. Thanks so much, Andy.
Cheers.
Thanks so much for tuning in to this episode of the podcast, and we'll see you next week's episode.